Yesterday's stock sell-off may have you wary of any equities, no matter where they come from, but record earnings this year pulled in some of the highest profit margins since 1993, and that could give CEOs the confidence they need to boost dividends. Well, for more on how to play this trade, we're joined now by Richard Turnill. He's a portfolio manager with BlackRock, the largest investment management firm in the world. Turnill's team oversees $10 billion. Great to have you on the show, Richard.
Great to be here.
Let's talk. I mean, a lot of people, of course, always asking whenever we see a pullback like this in stocks whether or not it's an opportunity to buy. What's your general view on that?
Yeah, I think this is an opportunity to buy. I think when you look at the opportunities across global equities today, there's a tremendous opportunity, particularly in what I consider high-quality stocks, which are paying and raising their dividends. And the events in Japan, the events in Libya have led to a widespread sell-off. And I think this is a great time to be getting in and buying some of those higher quality names.
Where do you see those higher quality names? Let's first talk regionally. You've already taken away all exposure directly to Japan in your portfolio.
Well, we had no exposure to Japan, to be clear, before this event. So we still have no exposure to Japan, although I think there are some stocks in Japan starting to appear on our radar screen. But we're global investors, so we're looking for best ideas wherever those companies happen to be listed. So where do we find opportunities today? Some great opportunities in Europe where you get very attractive yields, the yield on the European market close to 4%, but importantly we're getting very strong dividend growth. Some great opportunities here in the US as well. The US is a lower yielding market, but within the US market you've got some very high quality businesses which are paying high yields and raising those yields. Stocks in the telecom sector, stocks in the energy sector, which we think look very appealing right now.
Now, bank stocks, there is some talk about potentially we may see bank dividends rising. Are you taking an early look at that trade and already sort of positioning yourself to take advantage of higher dividends?
Yeah, we are looking at that trade, but we're actually very nervous about it because, you know, what history tells you is the way to make money is to buy companies which can pay, sustain and raise dividends over time. So the type of stocks we're looking for are the companies that can pay dividends not only in the good years but also in the tough years as well. So again, we're looking for the higher quality stocks, and I'm afraid many banks just don't pass that quality screen. So yes, you may well see a number of financials returning to dividends later this year, perhaps in 2012, but we'd be very nervous about buying into that trade because we question the sustainability of those yields longer term.
Now, given the events in Japan, what we're seeing in the Middle East, have you positioned your portfolio to take advantage of any potential outcomes?
Well, when I think about what the consequences of those events are, then one of the consequences I think you're going to see somewhat slower global growth over the next few quarters. I don't think this gives you a double dip. I don't think it gives you a recession. But I think what it does, it takes some of the steam out of the global economy. And as you see the pace of global growth slow, I think that's a time to perhaps reduce some of the cyclical exposure in portfolios which have done very, very well over the last 3 months.
Any specific companies in that area?
Yes, I'd be looking to reduce some of the industrial exposure perhaps we have in portfolios. So, you know, stocks which have been very strong. So I look at some of the European names, perhaps like ABB, which have performed very well. I think it's time to just take a little bit of profits on some of those names. But on the other side, I think this is a great time to be increasing and continuing to hold energy names. I think the oil price now north of $100 gives incredible value, particularly in some of the large integrated names, which historically there's been a lot of nervousness around the cash flow, but actually today they're becoming incredibly cash flow generative. And with oil anywhere north of 80, these companies don't only have the ability to sustain their dividends, they have the ability to dramatically increase their dividends over the next few years. And you have a very big margin for error there with oil where it is today.
Yeah, absolutely. Oil at 80 and your investment thesis holds. All right, Richard, thanks so much for joining us this morning. Appreciate the insight. That was Richard Turnill, BlackRock Managing Director and Portfolio Manager.